Are HELOC interest rates beating mortgage interest rates in 2024?
Yes, if you know where to look, which obviously we know where to look. And that's what we have a team. That's what they do. It's part of the service that we provide to our clients is knowing where to look. We specifically like community banks and credit unions, not the large institutions. And the answer is also no. If you were to Google, a bank, then if you don't know where to look, then yeah, their interest rates are either at mortgage rates or even inferior to mortgage rates. Here's what a lot of people do. Let's say you bank with Bank of America. Who's the first one you're going to look at for a home equity line of credit? Bank of America. And the other thing is because now that we're so far removed from 2008, mortgages are uniform. The interest rates are almost the same no matter what lender you talk to. Guidelines are the same because the government has taken almost full control of the mortgage industry. Yep. That people have become accustomed to, and this wouldn't have been the case in 2006. But now that we're 2024, they just make the assumption that, well, if all mortgages are the same, then all HELOCs are the same. So they make that correlation that all HELOCs are the same. Right. Nothing could be further from the truth. Prior to 2008, if you're talking to a lender in New York, Florida, California, they had different guidelines, they had different interest rates, they had different service, closing times, et cetera. It was vastly different. It's not that way anymore. HELOCs are still that way though, because this is a very specified loan product for that bank. So they have different appetites for risk, different thresholds as far as what they're willing to have on their balance sheet. So Bank A is going to have entirely different interest rates and programs than Bank B, and Credit Union C is going to have something entirely different than Bank A and B. So you really have to scour the market. And there's over 12,000 HELOC institutions in this country, so we've only scratched the surface, but we're probably 1,500 banks in at this point. We've identified a couple hundred that we like to work with, and by and large, they tend to be small credit unions and community banks. But if you know where to look, the HELOC rates can actually be substantially lower than mortgage rates. But you ask the question, are they lower because you think that that's what drives interest, right? We've been trained to do so. Especially now that we're 98% of Americans consume mortgages. They don't consume alternative products. We've just been indoctrinated and really trained to ask what's the interest rate, because we have been advertised to that is what moves the needle, and it's not. There's two factors that are far more important than interest rate. It's time and balance. So if you have a lower balance but a higher rate than somebody that has a higher balance and a lower rate, you potentially, depending on what those numbers are, you could still pay less interest than someone with a lower rate because the balance is lower. Same thing with time. We know this. If you got a higher interest rate on a 15-year loan than you did on a 30, you're still going to pay less interest on the higher rate because of the time. So time and balance is far more important than interest rate. So I get where the question comes from. That's what everybody asks, but they don't know why they ask that. So I'll give the straight up answer is, yeah, you can get substantially lower than mortgage rates if you know where to look. But I want to give the long-winded answer, which is, why are you even asking that to begin with? Because you think that that's what dictates how much interest you pay, when it's time and balance that truly dictate how much interest you pay.
What causes the general interest rates for mortgage or HELOCs to go up or down?
Okay, well, let's talk about mortgages. You've got the T-bill. Well, not necessarily the T-bill, but you've got the 10-year Treasury. You also got a 2-year Treasury. So right now, the 10-year Treasury is sitting at 428 basis points, 4.28. Down a little bit today, 2 basis points. This is the craziest thing that I have seen, and I've been through a lot. I got in the lending business 2001 and technically been in it ever since, some form or fashion. But this is just in 1 month. I mean, look at that graph. Let me see if I can turn it sideways. No, you can't turn it sideways. But you see that graph? It's like a freaking heartbeat. That is not normal. That's not what I'm accustomed to. And that's over the course of 1 month. I mean, you look at 6 months, we've had swings from 400 basis points up to 472 basis points, now back down to 428 basis points. And that's just in 6 months. These are wild, wild swings. But back to answering your question, is typically if you follow the 10-year Treasury, then you'll see what mortgage rates are going to be. If you see a dip in that, that's what we used to follow as lenders. is the 10-year Treasury, and still do. Lenders still do it to this day. And you've got experts that can kind of somewhat predict what it's going to look like tomorrow, so that you know when to lock. Because the last thing you would want to do in the mortgage industry is say, all right, I think interest rates are about to go up, so let's go ahead and lock today. And then guess what? Tomorrow, they plummeted. You've locked them in. So now they're stuck with that. So one of their alternatives is, okay, well, I know that the lender across the street who doesn't even have my application yet doesn't have me locked, so I'm going to go take advantage of that over there. You lose a customer, so you have to be aware of these things. So that dictates what mortgage rates are, if you wanted to follow that. In the HELOC world, to a certain degree that is, it depends on the index that the HELOC is tied to. So most HELOCs are tied to prime. So when you see those wild swings, when prime changes, let's say the federal funds rate and what the Fed does, for instance, they're projected to lower rates soon, as early as this month, as late as at the end of the year. When they do that, you'll see an impact on your home equity line of credit. Probably within 30 days following that, your rate will drop on your home equity line of credit. But that's on the prime, vice versa. If it goes up, like what we've seen over the last 2 years, where every time they make a change, guess what? The bank makes an adjustment and your HELOC rate goes up. Those that are tied to prime. But not all HELOCs have to be tied to prime. Again, these are bank products. This isn't government products. So they can tie it to almost any index that they want. In fact, we've even toyed with creating our own index, not here at Replace University, but with the bank venture I'm at, creating an index that is tied to that. So I had one bank venture, we were tied to LIBOR. I've got a new bank venture, it's tied to a 6-month T-bill. So it only changes every 6 months. You could have one that's a 5-year T-bill. You could have it based on COFI, which is the cost of funds index. You could have it SOFR, the secured overnight funds rate. So, it's up to the imagination and creativity of that bank. Unfortunately, the current FDIC commissioner. When I say unfortunately, because there's a lack of creativity there. So that's what dictates the interest rates. But again, you ask interest rates because you think it matters the most. It is a component, but it's not the most important component of borrowing money. It's when you pay it off, time, and what the balance is. That's what dictates the interest rates. Not the interest rates, that's what dictates how much interest you pay.